Now, understand I've been working very hard, so I haven't been a reporter. Jay tells me that the conference has 20 or 25% more attendees than last year, that 50% of the attendees are fresh to the conference, if not fresh to the space. So interest is picking up. Some of the booths have told me that in addition to the fact that there are more people, the people are better informed. If that's true, that's very bullish. More people and better informed people can only be good for the resource space. I think it should go without saying, I'm sure you've noticed this, that Jay works very hard and the conference is getting better and better. It may be a testimony to the quality of the conference rather than a testimony to the popularity of the industry, that attendance is increasing and the quality of the attendees is increasing. But if it's true, it's very bullish. Gold is up because foreign central banks have bought it, and foreign central banks don't buy stocks. The fact that this is a mystery to people is highly amusing to me. If you have related markets where you have one community that buys one asset class and they don't buy the other class, that's easy to explain. If you look at physical gold buying over the last 48 months, 4 years, there's only been 7 months of positive retail inflow. So the buyers of gold have been foreign central banks, and the foreign central banks aren't buying stock. That one's easy, but it's still bullish. I believe in terms of the upside in the price of gold that retail buying will follow institutional buying. And then two things will happen. One, the increase in the whole sector will spill down to the equities because this new buyer, the retail buyer or the non-central bank institutional buyer, is agnostic. They'll happily buy the equities if they think they can make more money there. I think the disconnect, not just in gold, but across the commodity spectrum, is one of the bullish aspects of the market. I think it's particularly acute in gold, which is another way of saying that probably the gold equities are particularly attractive relative to the others. There are a lot of companies here. I own, either in my accounts or accounts I manage, 20 of them already, so they weren't new stories to me. And this isn't the right format for me necessarily to hear new stories. The right format for me to hear new stories is walk from office to office downtown and hear the stories at length. This is a conference where the idea is to attract retail investors with a narrative. I already know the narrative. I don't care. So I want to spend an hour or two at a time, and this isn't the time or place for that. Everybody cares about what's hot. It's already overpriced. Look to what's not. In this business, it's capital intensive, it's cyclical. You are either going to be a contrarian or you're going to be a victim. Those are the two choices. So don't look what the hot story is, except for when you're looking for something to sell. Look what's out of favor. Look for the sector that's out of favor, particularly if it's a commodity that you know demand will continue to be strong for. That's the first thing. Find what's hot. Don't find what's not. The second is that most retail investors own many too many stocks. I advise people at the Rule Classroom to own the number of stocks that corresponds with the number of hours per month you're prepared to spend understanding the stocks. So somebody transfers a portfolio in to me with 60 or 70 stocks. I say, do you spend 70 hours per month on this? If they say no, I say, well, how many hours do you spend? They say 4. Okay, own 4 stocks. The third is that people who invest in natural resources invest with a very long-term narrative, a thesis. Copper price, exploration cycle, development. They are investing in a circumstance that will take 4 or 5 years to generate the outcome. That's the strategy, but the tactic is 3 or 4 months. The juxtaposition between the time it would rationally take the thesis to play out and the time that you're willing to own the stock has to correspond, and it doesn't. Many people invest in something that has a 5-year thesis, and they get shaken out holding the stock over a over a long weekend. Here's a statistic that your audience will love. Fidelity Management, the great big mutual fund group, millions of clients, and they sliced and diced the clients by all kinds of metrics: race, sex, age, profession, everything like that. The best performing subset of Fidelity clients over 10 years, dead people, people that didn't trade. That really tells you something.
It does. Yeah.
The more emotional you are, the more you trade, the more you follow trends, the more you follow fads, the worse you do. I do have a different approach. I think in a period in time when mining is out of favor, which it is, when the prices of the equities are not reflective of the commodity price, when the enterprise value or net asset values are at all-time lows, which they are now, that you want to be in the space. But what you don't want to do is chase alpha. What you do as an investor who isn't going to waste time is you find the biggest and the best companies in the space. In the gold space, as an example, you can chase 3,000 names, or you can construct a portfolio of Franco-Nevada, Wheaton Precious, and Agnico Eagle. In a gold bull market, surprisingly, you'll do a little worse in those because the gamier names will outperform them, but you will grab the market beta, which might be 300%, and you'll take away the operational risk. So investors who aren't willing to do the work need to get help to find the best of the best. Then they need to buy those, and they need to relax until mining is on the cover of Barron's magazine or Fortune or something, and it is popular. I think the effect will be limited. I think that Mr. Trump will likely ease the de facto regulatory burden. I don't think that the legislation will change an awful lot, but I think the willingness to impose the regulation will change. But understand that mining and minerals in the United States, oil and gas is a big business, but mining and minerals is a little business, and that isn't going to be his focus. To the extent, too, that he does change the regulatory burden, understand that you still have local concerns and state concerns. So if you want to play the Trump game in resources, confine your response to Alaska, Wyoming, Nevada, and Texas. Confine it to 4 states where there's local and state support for resources. Don't try to juxtapose the national easing to states like California or Washington, where the local citizenry are foursquare against mining. Well, I think the oil and gas industry, first of all, is undervalued. It's undervalued because the big thinkers, the political people, believe that peak oil demand occurs in 2030. The Angela Merkels of the world, Justin Trudeau's of the world. What was that energy physicist? Greta Thunberg. Yeah, that's her. These people suggest that we have the end of oil. Well, how are they going to fly their 1,000 private jets to Davos to tell you less without jet fuel? It's not going to happen. Peak oil demand is 2065, sometimes like that. So the net present value of these things is much higher than the market thinks. And this is global. But Canada is about to undergo, I think, a fairly profound regulatory change. Mr. Trudeau believed for some reason that there wasn't a business case for Canadian natural gas. Now your trading partners, China, Japan, Korea, Germany, they were begging for gas. And the arithmetic was that gas that cost $2 at Alberta Gate per million BTU sold for $14 at Rotterdam. It took $3 to get it from there. So $5 total cost to sell for $14. The customer wanted it, but there was no business case. Political fiction. Now that Mr. Trudeau has decided to pursue other employment opportunities, I think that headwind is out of the way. Similarly, there was a problem with access to market in the United States. While the Biden administration didn't change very much by way of regulation, they imposed a regulatory burden around the infrastructure required to move Canadian oil and gas through the U.S. Canadian heavy oil to the U.S. Gulf Coast refiners who wanted it and needed it. That's specific oil. And Canadian natural gas into the U.S. West Coast market and through the U.S. Eastern Seaboard to European markets. Mr. Trump has been very, very vociferous about the fact that he would reduce the regulatory burden on oil and gas transmission in the United States. If you remove 2 headwinds, one the Canadian political headwind and the other the U.S. political headwind, and you think about a world that's very eager for the stability of Canadian oil and gas assets, this can only be very bullish to a sector that was already cheap. If Canada elected, what's that guy's name, Carney, I'm sorry.
Carney, yeah.
That would be very bad. If you had,
why is that?
If you had a statist of Carney's ilk, who, unlike Trudeau, was competent. The good news, as far as I was concerned about Trudeau, was although I think his interests were antithetical to mine, he was fairly ineffective. Carney is extremely effective. And if Carney were elected, that would derail my whole thesis. You would have somebody who was anti-oil who was also competent. That would be the worst of all possible worlds. If your current poll leaders, Polyev, ascends to the prime ministership, particularly given the fact that he's from Alberta and understands the business case for oil and gas, that would be extremely bullish. Now, I understand that there's, well, Mr. Trudeau has suggested that he will resign. He won't resign for a while, and so it's going to take a while play out. I mean, $800 trillion in savings and investment assets in the world. 3 trillion of them are crypto, which is to say, like gold, it's a sideshow. They aren't competitive with each other. The second thing is that I've learned in my life, as I say, the best performing investors at Fidelity are dead people. The crypto people are chasing what's hot. When Bitcoin was at $1,000, when you could make a case for it based on the net effect, network effect, nobody cared. At $100,000, when it's up 100-fold, everybody cares. You need to ask yourself, are people chasing momentum, or has something happened intrinsically to make the network effect in Bitcoin 1,000 times more valuable in 10 years? I would suspect no. I don't own or not own Bitcoin because I invest in things I really, 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 truly know. I would suggest to investors that money is made by buying assets that are out of favor. And it would be difficult for me to describe crypto as out of favor. I would suggest, however, that people whose time frame is limited to a long weekend not think about natural resources. I would encourage them not to think about investing at all, frankly, but that's a different question. But if your time frame is that you are going to limit your portfolio to things that you're psychologically comfortable in because they've already increased dramatically in price, in other words, if the price action is required to justify the narrative, I would suggest that you not invest in natural resources, and in fact, I would suggest that you not invest.